And we're live. Good morning, YouTube. Good morning, everyone. It's Friday, December 6th. It's 9:15 a.m. I hope everyone had a good week, or at least a decent week. Good morning to everyone in Discord, secret Discord land. Let's have a look at the pre-market tape. Unemployment figures were just released, which never matter, obviously. S&P futures are up 0.14%. NASDAQ is up 0.14%. Dow's up 0.16%. The Russell's up 0.72%. VIX futures are down 1.87%. Treasuries are up 0.1, 0.4%, short-term versus long-term. Gold's about flat. It's up 0.08%. Crude is down 1%. Nat gas is down 0.88%. Bitcoin is down 0.3%. Japan, the Nikkei ended down 0.6%. China ended up 1.2%. And the FTSE is flat, as is the dollar. Nice little move on the SPY after the jobs report. Let's see, what was it? Unemployment rate was as expected. Earnings were a bit higher. Well, that's nice. Nothing to go crazy about. I made several earnings plays, double diagonals, double calendars, and I'm going to be keeping an eye on those as the markets open. Lulu had a nice big move. I believe they're up about 10% pre-market. Is that right? Just about. Ulta had a big move, up about 9%. And I traded DocuSign. DocuSign's having it's maybe up 15%, something like that. That one I might actually have to manage. And then UiPath looks like they're about to be flat. So that one I should be good to go. King D, I don't know. I don't think you're going to win our bet. It's close. It's getting close, though. Let's see. Toast is at 38. And it's about 38.40 pre-market. Zim trading just below 21. Yeah, I'm still in the lead. It's close. It's about a 6.5% spread. How's year-to-date performance looking? Year-to-date performance is pretty good. I mean, hell, you could have been brand new to investing and trading and just picked shiny stocks, and I think you would have done well. Even King D did well with Zim because Pirates. No, I'm sure you still would have done well. I mean, I had some great plays that worked out significantly better than I thought they would. But to me, all that matters is that I actually beat the market. So what was it? Robin Hood? Man, what a meteor. Look at that. What was it, close to 16 maybe? I think Robinhood and Toast were about the same price. I got in at about the same price. And they both kind of did the same thing. Up like what, 250% or 150% on those about? Toast pulled back a bit. Yeah. Solid. Actually, Robinhood got in later, I believe. And let's see, what else was there? Oh, there was Bristol Myers. That was a decent size play. Average down, dollar cost average from, what was it? Maybe 55 down to about, I want to say close to 40. It was about 40. I think there was or maybe it was 50. I remember like the big obvious levels, 50, 45, and 40. I think that's what it was. Yeah, and now we're sitting at 61. So that was through that dip in June and July. So that was that was just classic value investing. Nothing too sexy there. I think they had a decent dividend, yeah. Yeah, the dividend was sitting at 5%, wasn't it? So Bristol Myers was good. What else? Genius Sports. Yeah, that one took off. I was looking rough at first. I think average price was around 6. Maybe just below 6. I remember dollar cost averaged in. Hit a low $4.91, and now it's almost at 10. Went above 10 for a bit. That one's been doing well. And so far, ASML's looking nice. Average price of about $6.70. Yeah, so looking good on that so far. Added some other stocks recently, smaller plays related to secular trends, dollar cost averaging into those. You can view those if you're wealthy and one of my beloved donors. What was my worst play of the year? Let's see. There were a few plays that just sucked it up at the beginning, like Viasat. But Viasat was, I guess, from last year. And then that one, I just had to cut. It was just like, okay, it's not going to happen. But it did cut that earlier. But honestly, I think from the point that I got in to the point that I got out, I remember, what was it, maybe August? That spike? Yeah, okay, so there's that spike. And I remember posting in the server, it's a good time to take gains. And I took all shares off the table. I think I was already trimming the shares. And then I said, if I'm going to have any exposure, it's just going to be some calls, and that's it. And I'm leaving it alone. But all considered, I think getting out there, I didn't really lose that much because I got in at around, maybe average cost was like 15, 17. But when I think of loss, I think, what stock did I buy? Did I do due diligence on? Keep track of? And didn't beat the SPY. To me, that's a loss. So even if it was up, I still would consider it a loss. What about Warner Brothers? That one, I guess I'm still kind of holding. I hear someone rummaging. Andy, welcome.
Morning.
Good morning. Let's see. Warner Brothers finally came back to life. Yeah, it's had a crazy run since that August dip. Spirit Airlines. Yeah. Yeah, Spirit Airlines that was a how on earth could that merger be blocked, you know? That doesn't make any sense, but here's some fun charts. I did look at the airlines the other day. JetBlue's it's been rocky for them. That chart, these past 2 months have been nuts for them. You got a low of about 550, a high of 8, and they're just up and down. That might be a great stock to trade. So that's JetBlue. Now, Spirit Airlines, they declared bankruptcy. They're trading with OTC now. Here are the big 4 airlines. American Airlines. Look at that chart. Just took off from August. Southwest Airlines. on fire as well. United Airlines. Oh man, United Airlines is doing insanely well. Delta. Yeah, the big four airlines, wouldn't you know, they took off once that merger was blocked. Funny how that works. Good job, DOJ. Yeah, that was pretty surprising. But yeah, I guess that was a pretty maybe yeah. I guess percentage wise, that was the biggest loss for me. It was Spirit Airlines, and then I think closed just like sealed sealed the door. Maybe it was I want to say it was above 7, maybe close to $8 a share, and it was kind of like okay, it's game over. Like that was the only thing that would save, and it didn't happen.
Ha.
Ha ha ha!
Save.
Yeah, you see what I did there? I'm smart. Yeah. So that one sucked. I don't know. There may have been a few others, but yeah, overall it's been. I, I think I kind of want to say easy because some of these stocks. I think I don't know if some of you guys remember the beginning of this year, maybe the end of last year, beginning of this year. There was a lot of data supporting going long small caps, but I hate the small cap index because I think it's just got a lot of trash in it. However, the data was I mean it's good data and it made sense from a macroeconomic perspective, and really just from like a technicals and trend perspective, the Russell had been underperforming for a while, which you could explain, but at some point it is kind of, all right, the markets might want to rebalance at some point and pick up some small caps. But as much trash as there is in small caps, I decided I was going to get very, very picky, and I was going to be cautious. So that's where, a few of them like Hood and Toast, those are stocks, Toast especially. Well, I guess Hood and Toast. I think I put the same weighting into both of them because I felt that they had a strong business. I didn't feel like I was gambling on small cap stocks. Those were almost no brainers to me, and then they just took off. So I'm still glad I went strict. Otherwise, it would have just been all right. Just go long small caps and that's it. And maybe that would have worked as well. Let's see, IWM. Beginning of this year, it was about 190 when I started looking at Hood and Toast. We'll call it about 190, 190, 200, and I was sitting at 245. Okay, not bad, but I made 150% on Hood, 135% on Toast, 130, something like that. So, and then the mega caps took off. Everything took off. So, I don't know. If you didn't make money this year, woof. Time to reconsider. Get into gardening. Market's about to open in about 15 seconds. Gonna give the markets about 5 minutes or so to get some liquidity before I start to manage those earnings trades I did yesterday, which I want to say 3 out of 4 are solid. Maybe DocuSign is. Maybe I have to manage that one a bit. And we're off. S&P's opened at 0.1% up. NASDAQ the same. Dow up 0.16%. Russell up 0.6%. All right. And while liquidity kicks in, I'm going to go ahead and I do have a few trades to close, actually. Let's see. Oh, we're going to have to wait on those. Okay. Yeah. I'm just going to wait for liquidity to kick in before I manage some of these trades. Let's look at the news in the meantime. So speaking of earnings, Ulta, let's see, they are up 10.5% after beating third quarter estimates. Reported earnings per share of $5.14 versus $4.54 expected, and revenue of about $2.5 billion or $2.53 billion versus $2.5 billion expected. They also raised their fiscal year outlook, projecting sales of $11.1 billion to $11.2 billion. Buffett already trimmed Ulta, which I thought was strange. Maybe it was fear from Chinese exposure. Not sure. But at any rate, whatever he has left is doing well. Lululemon is up 13%, 13.5% now. Beat third quarter expectations, beat on earnings, beat in revenue. International sales grew 33%, offsetting a 2% U.S. decline in comparable sales. They raised fiscal year 24 earnings guidance and expanded its stock buyback plan. Yeah, Lulu is that thing's launching. Yeah, congrats to whoever still had those Lulu calls. That ended up working out. Boeing, their plea deal has been rejected. Federal judge tossed out Boeing's plea deal with the DOJ over the 2019 737 MAX crashes, claiming that the $487 million fine and proposed safety investments sidelined court oversight. Separately, Boeing has yet to resume 737 MAX production following a strike this fall, although I believe they did announce this morning that they're now they think they will. So, classic Boeing. They're trying to do better. DOJ says, we don't think you're doing better. You can't do this. Then Boeing comes back and says, we're going to try to do it. That's kind of how Boeing goes now. It's too bad their stock-based comp is over $2 billion. Otherwise, they would start to look like a good turnaround play. Healthcare companies are reevaluating safety risks to their personnel following the fatal shooting of a United Health executive this past week. Cigna was down 2.3%. Molina Healthcare was down 3.2%. United Health fell over 5% yesterday, but I think they're pulling back now. Oh, never mind. I spoke too soon. They're down again. Yeah, they were up pre-market. Yeah, suspect in that killing, they are still somewhere out there. Yeah, pretty strange. And you have a lot of interesting commentary on the internet. You have a few guys trying to geolocate him on Twitter. It's very helpful.
Why?
Just to try to find a murderer, I suppose. Because they're good guys. Airlines. Southwest and American Airlines raised fourth quarter sales forecasts, citing strong demand and higher fares. Southwest expects unit revenue growth of 5.5% to 7%, while American projects flat to 1% growth and boosted its earnings estimate to 55 cents to 75 cents per share. I think American had a crazy day yesterday. Yeah, they ended the day up almost 17%. That's just insane. OpenAI is reportedly considering removing a clause restricting Microsoft from accessing its advanced AI models upon achieving AGI. What is AGI? Let me Google that. Unless someone knows. By ditching AGI clause. Okay, I don't know what the letters stand for. I just see descriptions of it. Whatever. Advanced General Intelligence? Oh, okay. Yeah, all these news, I just glanced at a bunch of news sources real quick, and it's like none of them actually new. Artificial General Intelligence? Are we just guessing? Whatever, I'll take one of your... Yeah, why not? Why not both? AI is taking over. That's all we have to know. AstraZeneca's new China head. That's a weird headline for that. AstraZeneca named Iskra Reich as its new China chief, replacing Leon Wang, who is detained in China for alleged insurance fraud. The company faces probes into insurance violations and illegal drug imports, affecting investor confidence in its China operations. AstraZeneca up to no good, says China. Dollar General is exploring same-day delivery at 75 stores, which plans to expand, with plans to expand to thousands. They have thousands of stores. Wow. The Dollar General delivery program, Triple D, aims to compete with Walmart and Amazon, offering in-app ordering, store prices, and 1-hour delivery. I'm sorry. Who the hell is ordering 1-hour delivery from Dollar General? You know what? No judgment. If someone in the chat is excited about 1-hour delivery from Dollar General, you may share, and there will be no judgment. Okay. All right. I mean, the stock price moved up on the news. I don't know if markets understand the economics of Dollar General and its target audience. Crypto-linked stocks, MicroStrategy, Coinbase, and Robinhood initially rose yesterday following Bitcoin surge above 100K. That's right. Bitcoin finally broke the 100K mark. And guess what? It's back down below it. Not by much. So, yeah. Those stocks later fell, with MicroStrategy, Riot Platforms, and Mara Holdings down 4-5%. 4.25%, that is. MicroStrategy flat, which is a surprising thing to say any day. Taylor Swift's self-published Eras Tour book sold 814,000 copies in its first weekend, second only to Barack Obama's A Promised Land in terms of nonfiction first weekend sales. It's selling exclusively at Target, where the book bypassed Amazon and traditional bookstores. So just a Target. Interesting. I wonder if that's going to actually have an impact on Target sales. Guess you got to buy candy when you go to Target to buy your fresh copy of the Eras Tour. Waymo is heading to Miami. Google self-driving unit Waymo announced plans to expand its robotaxi service to Miami, beginning tests with safety drivers in 2025 and offering rides in 2026. I believe Uber and Lyft were down quite a bit yesterday on this news. Uber has since pulled up about 2%. What about Lyft? Lyft is up about 1.5%. Looks like Lyft took a bigger beating than Uber. I wonder if people in Miami are going to greet the Waymo cars the same way San Francisco did, by setting them on fire. Because we're civilized. So we haven't caught up in a spell. Didn't do Monday. Monday's market talk didn't do last Friday because of holidays. And I took an extended Thanksgiving vacation. How was everyone else's Thanksgiving? What about the non-Americans? How was your Thanksgiving? Nobody ever asks you. You never talk about it.
Wonder why that is.
I don't know. Haven't the slightest clue. Haven't the foggiest. Anyone from London? King D? Foggiest? Is that a thing that they say? In old swashbuckling Dublin? Lulu's up 17%. Madness. Let's see. All right. Is it a good time to manage these trades? I think I still have some extrinsic left. Oh, not quite. Not really. Lulu's on fire. In a good way. DocuSign is now up 21%. UiPath is down 6.2%. Let's see. Is there any extrinsic left? Oh, yeah. 36 cents of extrinsic left on those puts. Oh, I see. Yeah, I think I'm going to wait on those.
Oh, wow, DocuSign. That's nuts.
Oh, it's nuts, all right.
They were down after hours. They were down after hours, too.
Yeah, for maybe like a minute.
Okay.
Yeah, it was just a quick dip, yeah, and then into the stratosphere. I made a sneaky little play on Walgreens yesterday. I sold some puts, and I bought some calls, strike 8.5. Those are already in the money. Let's see what else we got. Yeah, I made a lot of plays yesterday, and I think I need to close out probably about half of them.
Wow.
Roblox is down 1%. When is that investigation going to be public? I don't think Hunter Brook was lying about that. They said there's an undisclosed investigation that's going on.
Walgreens had a pretty big fall from grace, huh?
It's true. I don't know that they were ever graceful, though. Pfizer, some of their executives had lunch with Trump and RFK Jr. That's obviously insanely bullish for reasons we don't know. What else we got? I might be adding to a few long-term plays today. Man, what a move on Lulu. Yeah, look at that. Look at Lulu. Mean reversion. Nice. Nice when it works. Tends to work a lot. Intel, did it find its footing? Maybe. Very low volume. Relatively speaking. SPY's starting to move up a bit more. It's up 0.24%. NASDAQ's up 0.45%. The Dow settled a bit. It's up 0.09%. The Russell's up 0.4%.
When is Walgreens gonna have their mean reversion?
Ha 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 ha. I mean, looks like it already started. Let's see. Yeah, it looks quite perilous for Walgreens. Yeah, that chart. Let's look at that chart. Oh man, 5 years. Let's see. Can we go back longer? Oh man, that's just bad management. You're trading at $97 back in 2015, and it's been almost a straight road down since then. $97, now they're trading at $8.63. How does that happen for a company that big? Well, I mean, I know how it happens, but usually that involves something like fraud or something, you know? But not in Walgreens' case. It's just a lack of actual management.
CVS just took over the market share.
Well, I mean, there's CVS, and then you have, you know, like you had Amazon. You have a lot of other companies trying to take over, trying to gain market share. And Walgreens, they just, I mean, man, they got way too comfortable. CVS, I think they've had a similar road, but I don't think it's that bad. Yeah, not exactly.
Well, also CVS bought a healthcare company. CVS bought Aetna, which helps them a lot.
Yeah, there's still
CVS has a PBM integration.
Yeah.
I mean, the stock price has still been sucking over the past few years, but yeah, overall, better than Walgreens, but that doesn't say too much. Yeah, that whole space has just been screwed.
I don't understand myself, honestly.
I mean, they're having an existential crisis, so you know, why go to CVS or Walgreens? Like I never go. Maybe years ago I used to go, but yeah, so I get it.
Do you take prescription medication, Luce?
Honestly, hardly ever. Like
right.
Like I'm not like fucking RFK Jr. I'm not like I'm not mental about it, but I try not to take like antibiotics. But if I really freaking need it, then
you don't have like a chronic condition or anything that causes you to need.
Right, but I mean, a lot of places don't they just mail them to you?
Yeah, that's becoming a bigger trend, and it's hard for in-person pharmacies. Can't do that with regulated narcotics though, like ADD medications. But even those, they have trouble stocking nowadays.
I mean, those medications are basically methamphetamine, right? Or methamphetamine, right?
Yeah, basically legalized meth.
It's true.
I had some this morning.
Nice.
Speaking of drugs, isn't Texas? They're talking about getting rid of THC altogether. What, banning all forms of it?
It's going nuts about it.
Yeah, I don't think he's aware that his kids get high. You know what I mean? Like, I know it seems to be, particularly in Texas, seems to be a Republican thing or a conservative thing, but it's like, everyone smokes. Well, I mean, I don't, but like, I don't think it matters what political, beliefs you have. Like, I'm pretty sure at least half of the U.S. smokes something, does some kind of drug.
Yeah, so he called THC life-threatening, and
then took and then chugged his his MD-40.
Right, exactly.
Yeah.
I mean, THC is really bad for adolescent brain development, but you can't stop kids from doing whatever the fuck they do.
All drugs are bad for adolescents.
Yeah, I mean, you want
Yeah.
to target a drug, let's target alcohol, fucking ban alcohol.
Even caffeine.
Yeah, I
they
mean-
prove that caffeine isn't good for adolescents.
They prove caffeine is great and bad. Like caffeine is such a weird fucking thing. It's like, oh, caffeine will give you a stroke before 70, or caffeine reduces your risk of heart attack.
No, caffeine. Most of the like when it's bad, it's because you have high blood pressure or
Right.
like there's always some other condition. But caffeine overall is fine. But for adolescents, for younger, children, yeah, it's not good. But yeah, you can say the same thing about, what else? Sugar. Like, hello, like you want to talk about drugs. Sugar's probably
Yeah,
the
I mean,
worst drug out there for kids.
I know, but like,
Yeah.
I like the studies that are like, first of all, the studies around THC and adolescent consumption are much more kind of universally, what's the word I'm looking for? Accepted to be true in terms of like really fucking up, like increasing risk of schizophrenia, depersonalization, for people who are especially especially for people who are taking it under like 22, 23. So like, that fucking sucks.
All right,
And-
we went
and-
37 minutes on YouTube before the video gets demonetized because Zaf dropped the F bomb. No, I'm just kidding. I'm not. I don't meet the criteria to be monetized, the sad criteria. But no, if it was, then it would. At some point, as soon as somebody swears, then it's demonetized. I don't care. I'm just making a joke.
Yeah,
But that's why I try not to cuss at the beginning.
I hear you.
No. Speaking of addictions, gambling is fun. And speaking of gambling, let's talk about stocks. Amazon's up 1.6%. Okay. Let's talk a little bit about Amazon. I don't know if you guys are big readers of the news, but Amazon is becoming, I don't know, world takeover. They got news about data centers, about making their own chips, renewable energy. Amazon is doing everything. And their stock price has been moving up quite a bit. But honestly, if Wall Street starts viewing Amazon as sort of like NVIDIA quality, not in terms of revenue growth, because I don't see how the hell Amazon could have 40% revenue growth, never mind 100% plus. But I think Wall Street's starting to view Amazon as like top tier, mega cap, top tier blue chip stock because of everything that they're doing and how they're diversifying the business, the technology that they're advancing. Amazon is not messing around. Every time Amazon dips, I'm probably going to sell cash secured puts. I don't know, maybe depending on the dip, maybe go long with some calls, long-term calls, something like that. Amazon is a beast. I don't think they have anything to worry about. Not really anything to worry about with an entirely Republican government.
Yeah, no one's gonna regulate them now.
Yeah, all of Congress, they're all invested. They all have shares of Amazon. So, just like they have shares of Apple, Nvidia, Microsoft. Apparently they have fewer shares of Google, and that's why they keep ragging on Google. But
I mean, I'm not sure that the Chrome shit is gonna, the Chrome stuff is gonna go through.
yeah, you can
either.
cuss now. It's fine. Google's, whatever happens, Google's going to appeal, and Google's probably going to win because it sets a massive precedent. And that means, okay, guess what? Microsoft, you're next. Apple, you're next. Like, yeah. So that precedent is the one thing that's going to prevent all of this. Otherwise, that's pretty. I don't want to say anti-capitalist. I don't want to sound sensational, but that would start a wave of like massive regulation on strict regulation on like the mega cap companies. Like that precedent would be wild.
Microsoft go through something similar in the 90s where they were forced to essentially unbundle large parts of their integrated 95 suite?
Was it the 90s? I can't remember.
Thanks.
I mean, they were targeted in the 90s. They were targeting 2000s. I think in the 2010s.
I think it was in the EU though.
Honestly, I think all these massive companies, the ones that are monopolistic, I mean, obviously, like nearly every single mega cap meets that criteria. When regulation comes after them, it's kind of like, all right, if there's a big dip in the stock price, you know, a few cases in point, you look at Meta, you look at Google over the past few years, regulation came after them. You kind of remind yourself, wait, this is the U.S., and they're not going to regulate this company into, you know, losing their mantle or to the extent that the monopoly in this industry is now invalidated. You know, like it's the U.S. They're not going to do that. So to me, I'm like, take advantage of a big dip in the stock prices. I think Google, the way I see Google right now, if Google were dropping the way Meta did when the U.S. government came after Meta, because I don't know if you guys remember, but the drop in Meta stock price, it started with big threats of strict regulation being enforced on Meta. And then it was Zuckerberg is throwing billions and billions of dollars into the stupid metaverse, right? So it started with government. If Google reacted the same way Meta did, I think Google right now would be closer to like 120. Right now it's trading at about 174. In other words, I think Google, I don't think it's necessarily like the markets just love Google way more. I think the markets probably, in terms of impact or in terms of dominance in their respective industries, they probably view Meta and Google somewhat similarly. That's why when you see big dips in the markets, big dips in communications, Google and Meta, they tend to move together and then they tend to move back up together. So I think the markets see them similarly, but the reason why you don't see Google dropping a big, just in like a very bearish trend is because I think that's how damn good of a company Google is. And I think the markets see that part now. Because Google they're making a lot of progress.
Right?
What's that?
Google's also like more diversified than Meta. It's got like it's more akin to Amazon than Meta, right?
They aren't, but a lot of their right now, I think Amazon's pulled up right next to Google. And that's happened over the past maybe year. Amazon has rushed to do that. And I think that shows in the stock price. And I know Google works on a lot of things, but the reason I would stick to that at this specific point in time, you asked me a year ago, I would have said, yeah, Google for sure. But now it's because they really figured out where exactly to invest their money in a way that would reduce their own cost and position them better within their industry versus Google. A lot of what they've done over the past 2 decades is very venture cap style. And they say, here are 10 ideas that we want to pursue.
Right.
Let's assign a team to each one. Okay, go figure it out. Let's see what you come up with. Quantum computing is one. Yeah, who knows if their quantum computing investments are going to pay off, by 2030 or at all, right? So they do have several businesses like that. Very intriguing. especially if one or two of them actually hit. But that's it's that venture cap style versus Amazon is like more like private equity, and they seem more focused and more. They know exactly how this business is going to provide synergies or help with costs, help them maintain their moat, etc. So I
Yeah.
think that's
I mean, that's
that's
one
what
of the
the mark.
reasons I
That's
think
the big
Google's
difference
great.
between Amazon and Google now.
Yeah.
But I think they're both like equally important. I think the difference between the stock price and the stock price movement, I think, is mostly sentiment. Rather than Amazon is just that much better of a business than Google is. I think Amazon is just they know exactly they figured out how to create shareholder value and while improving their business, which are often those can often be two different things. For example, share buybacks. That doesn't improve your business. That's just shareholder value, right? So when you're able to do both at the same time, Wall Street will fall in love with you. That's why Wall Street still loves Apple to this day. And every now and then Apple dips, right? But Apple's been one of the best Wall Street stocks, on creating shareholder value and maintaining and improving upon your business. Why everybody would say like, oh, Apple, they're done, they're not innovating. It's like, well, actually, they got a pretty good stronghold on their business, whether you like them or not. So now it's obviously, okay, I don't know that that's Apple anymore. Apple's doing well because it's Apple, right? But Microsoft has always been the contender for that. And I think Microsoft was for a while, it was kind of taking over in place of Apple in terms of like Wall Street's favorite. But now you have Amazon, and I'm thinking, yeah, maybe it's Amazon now. Wall Street darling, unlocking shareholder value and really just doing very well in improving your business, knowing exactly where to put your investments. And it took Amazon, it took them a while to figure that out. I don't know if you guys remember the Amazon phone. What was it called? But yeah, they had a lot of ideas that failed, and then they figured it out.
I mean, I'm happy to see, even ideas that failed from a larger company because it means that they're like aggressive about trying to find new places to expand.
Oh yeah, I remember. What was it like 2 years ago? Was it 2 years ago? Their operating margins went to zero, and that was like a low in the stock price. And I think I was still applying like an old school valuation method to them. They got 0 bonus points from me for being Amazon, and I was like, I don't like the valuation. But then over this past year, I changed the way I look at valuation for sure. And I realized looking back at Amazon, it's like, oh man, that would have been as much of a screaming buy as Meta was, back in the day. And I think it bottomed out about $80 a share, close to $80. And that was 2 years ago. Now they're trading at $224. And, okay, a lot of stocks, by the end from the end of 2022 to now, a lot of stocks did well. But frankly, would you have had the same amount of conviction on all those other stocks as you would on a company like Amazon, Talk about risk reward. How much are you risking? You buy Amazon at a relatively low price versus DJT. Moderna is up 8%. Any big news? Did Trump and RFK Jr. meet with their execs?
Might be disease X in the Congo.
Everyone loves disease as long as it isn't in the U.S. Actually, no. I think shareholders of the big pharma stocks, you love disease in the U.S. as well. The more disease, the better.
People, it's basically something that looks like some form of flu plus anemia, and people aren't sure if it's a huge malaria outbreak or some new COVID to start the 2025 year off.
Yeah.
Right.
I just scrolled up. Let me look at your guys' comments. King D, you're saying Thanksgiving is non-existent in Ireland? Ain't that a damn shame? We do celebrate Paddy's Day, good and proper. Yes, we do. Are these recorded? Yes. So I am streaming on YouTube live, unfortunately, for everyone on YouTube, to their dismay. But yeah, these are all the Monday and Friday talks. They're always going to be streamed live on YouTube. And right now, there are about 2.5 million people listening on YouTube. Yeah.
Okay.
And by 2.5 million, I mean 2.5, just 2.5.
Right.
Have they issued more shares, resulting in dilution and share price decline? Would that explain it? I don't remember what stock we were talking about. Was that Walgreens? Walgreens has had a lot of debt, lack of innovation. Not sure if that's the stock you were talking about, Chicken. Everything you haven't had caffeine in years. My condolences. Calls on UNH win. Why not now? Yeah, go for it. Yeah, buy some calls on UNH. That is 100% financial advice, and I'm ready to be sued.
It's crazy. I mean, it's not crazy how people have reacted to that.
It doesn't look good, but yeah, this is interesting because I don't think insurance stocks have. I mean, through the first Trump administration, they did very well. Regulation was very favorable towards them, and then the Biden administration, there was a lot of legislation passed that was difficult to interpret. It was the whole goal was to undo a lot of the regulation that was enacted during Trump administration. But it was, I think it's fair to say that it was as crazy, it was as complicated as the Dodd-Frank Act after the housing crisis. And that, the banks were complaining for years nonstop. This is the worst regulation ever. It's difficult to interpret. I mean, I was at Societe, the French bank, back in 2016, 2018. They were still interpreting parts of the Dodd-Frank Act. And, it was just nuts. I think it's safe to say that all the regulation that was passed, or they were trying to pass during the Biden administration, it was comparable. And when, one perspective, you could say, why would they do this? That stifles, their ability to profit, to do business. Well, that typically happens when it's been the Wild West and you have a handful of companies that have been able to run, an entire industry and, comparable to the banks, right? So I don't think anything similar to the housing crisis could happen as it relates strictly to insurance. But, I mean, you never know, right? But yeah, there's insurance companies. I don't think you ask anyone, I don't think anybody is going to say, I'm good with insurance companies. I love them. They're great. I love how they do business. I love how they eat away at my life. I don't think anybody would say that. So regulation was needed. The basic idea that insurance companies are massive publicly traded stocks, I think is a bit odd when you just think about it with a little bit of common sense. But it is what it is. But the regulation needed to be. It definitely felt rushed. It needed to be more clear. I know I heard about it a lot, talking to some industry professionals, bankers that focus on healthcare, and Yeah, I mean it's crazy. Like insurance really is a very complicated industry, and I would even say, or healthcare in general, across the board. You know, insurance, hospitals, just the way everything is run. It's so complicated, and the regulation did not help. So something needs to be done, but it's I don't know. Maybe we get what's his name from Argentina with the chainsaw. Maybe that's what we need to do
Millet.
for insurance. Yeah. So it's interesting what's happening because now it's like, you know, before it's like insurance, you can't touch insurance, and then they started having a big run up. What with Trump winning, lack of regulation, you know, this is going to be great for insurance. And you look at the valuations, I think it's safe to say that everyone's just ignoring their valuations, saying no, insurance companies they're kings, you can't touch them, right? And then something like this happens, and look at them drop. So
It was like really. I mean, I work like right next to that building, so it was like really fucking freaky going in.
So you know something.
No, I don't. I mean, I don't know.
Just kidding.
I don't go into work at 6. I go into work at 9. Best case scenario.
That's exactly what the Zodiac
Shit was
Killer would
cleaned
say.
up by the time I got there.
So yeah, I mean, you would look at this and say like, yeah, this does appear to be an overreaction. But what have you seen with, say, like high growth stocks, high risk stocks, when the first bit of bad news comes out, stock price tumbles 10, 15%. It's because those stocks were treated as if they were perfect. So that's what you're seeing with particularly with United Health right now.
Well, it's also like the increased scrutiny, right? The increased public scrutiny caused by like the assassination.
Well, I mean,
Like-
that's the whole thing, yeah. Yeah.
When people are reading constantly that United Health has the highest, denial rate on Reddit and shit like that, they're gonna be like, okay, this is a fucking terrible company. These are terrible people. It's like impossible not to come to that conclusion when you read about like, the auto AI denial. I don't know how true any of that is, right? Keep in mind, people can write whatever they want, and it's very easy to say something and then just like impossible to disprove it.
Yeah, no,
it
this is
doesn't
all
help.
sentiment driven based on, yeah, what just happened. And yeah. So, and it's going to be worse when stocks are priced to, how insurance stocks are. Yeah, that's the basic point there, yeah. But I mean, it's United Health. I'm willing to bet Kramer at some point is going to say it's a good buying opportunity, but I'm sure he's waiting because it's going to sound terribly insensitive if he says that right now. But I know how that old bastard thinks. Let's see. Shall I talk about SKEW? Because that's SKEW is doing very interesting things. I'm going to look at a few positions here real quick, and then we'll start talking about SKEW. The great SKEW. DocuSign's up 22%. Broadcom's finally having its move back up. That was weird watching Broadcom just kind of lag for a few days while other mega caps were doing fine. Yeah, just like that.
What do you think about their long-term prospects, Broadcom? Because it feels like the thing I hear is that their strategy is essentially, capturing their clients through like creating like really long-term dependencies and making it cost prohibitive for them to leave. But I'm not sure how that would be good for new business.
That sounds like every mega cap strategy. Yeah, most oligopolistic businesses. Broadcom, the way I look at at companies like these is I look at their track record. I look at their history, financials, and then valuation. And Broadcom, I said this what was it, a couple weeks ago, or when Nvidia was added to the Dow. I think it was not in line with the components of the Dow, with the theory of the Dow, to put Nvidia there instead of Broadcom. Broadcom to me was the obvious pick, and it's because they have, not only do they have such a damn good track record over the past few decades, but they're a semiconductor chip company. However, through the business cycle of semiconductor chips, they manage their business very well, and they'll make acquisitions, but most mega cap companies will. But over the long term, they've done very well at managing their business, managing their balance sheet. Cash flow is always strong, and they are not as susceptible. I can't talk. Susceptible to downturns in the semiconductor chip business cycle. So to me, it's like for the Dow, if you're going to add a company to the Dow Jones, you want a company that's like that isn't as cyclical. They also have a higher dividend, so I was like, yeah. So overall, Broadcom, to me, like the case for Broadcom, you just look at the track record, and it's to me, it's pretty obvious, particularly when you compare them to other semiconductor chip stocks. Broadcom they're a mega cap, and they're one of the big boys now, and they're going to be treated like that for a long time. So I would say look at Broadcom the same way you would look at Amazon, Microsoft, Google, Apple. They deserve to be looked at in the same light. And looking at the financials, looking at the performance over the past 10, 20 years, yeah, that's evidence of that. I think their dividend is still like, let me see, like 2%. Okay, it's 1.2%. Yeah. I remember their dividend was something like 2.5 or closer to 3, which is insane because they had that growth. Yeah, Broadcom's a great business. Aside from that, I was in them a while back. I got in them through their acquisition of VMware because you got a split of shares in cash. And then I held because I thought, you know what, that's when I actually started looking at Broadcom. And I was like, you know what, these financials are great. The business looks great. I'm going to stay with them. And then I want to say I cashed out. This was before the split. I think it was at like $13.50, something like that. So now it would be $135. And then it just kept going. So haven't looked at updates on the business in a while, but I would sacrifice a bit of very in-depth, focused knowledge on them and just look at them as like another mega cap company. And just, obviously still look at the financial statements, but yeah, not sure about their guidance. Not sure about their strategy, their up-to-date strategy, but yeah. Let's talk about SKEW. After I glance at AMC real quick. More dilution, you say? Oh, what about GME? GME's down 1.5%. Okay, SKEW. All right, so for those who don't know, SKEW, or the CBOE SKEW index, tracks the value of far out of the money puts versus far out of the money calls on the S&P 500 index. What SKEW attempts to show is sentiment of the markets relative to how overvalued or how fearful the markets are of tail risk. So this is specifically, you should specifically look at this as a tail risk indicator. One of the first questions that usually comes up for a SKEW is, okay, if it's looking at puts, if it's looking at say fear, what's the difference between it and the VIX and VIX futures? SKEW it relates strictly to the far out of the money contracts. Which that's where the tail risk part comes in. Tail risk being what are the chances that something really bad happens, something that people perhaps didn't see coming at all, such as a global pandemic, or Powell saying we don't care about your stock investments, or housing crisis, right? And so that would be tail risk, something that people weren't really expecting, and it doesn't just make the markets move down 5-10%. Usually it relates to a crash, tail risk, black swan risk. The VIX is a calculation of that is based on the values of all calls and puts, and it's more heavily skewed towards at the money. So you can see SKEW be at a very high level because markets are paying up for, say, like tail risk hedging insurance on far out of the money puts, whereas VIX is relatively calm because there's no short term. Nobody's expecting any short term volatility, right? And vice versa. You could see SKEW is very low, but VIX is very high. That's an actual indicator that the markets are going to rebound. So based on that last statement, you could jump to the conclusion and say, if SKEW being relatively low, VIX being relatively high, that means we're in for a market rebound. Well, the inverse, SKEW being very high and the VIX being very low, could perhaps predict a good market correction or maybe even a crash. That's what we're looking at now. However, the former scenario, VIX being very low, VIX being very high, SKEW being very low, markets tend to rebound quicker. Or we could say markets would be willing to buy the dip. Like if the SPY dropped from, let's see, what is that, 610 now? 609? Yeah, about 609. So if the SPY dropped from 609 to 500, yeah, markets they're getting ready to buy if they're not already buying. That's a great buying opportunity right there. Damn, we were below 500 a year ago. That's insane. Okay. It seems like a big drop, but it's not even, it doesn't even make up for the past year of gains. But at some point, markets are going to be very much willing to buy. You're going to see a lot of buying, and that's when VIX is going to start to go back down. SKEW is going to start to go back up. That tends to be a more reliable indicator because of the basic psychology of buying the dip, right? So even if the markets were to continue going down, there's still this mentality of around the world, within the markets, wait a second, we're supposed to buy dips, right? When the markets are just going up and SKEW goes really high and VIX is pretty low, the markets don't think the inverse. They don't think, I got to sell the peak. I have to sell the peak. No, the mantra, the psychology is you stay invested, right? And markets, institutions, they don't just sell at peaks because we're at a peak, right? And the data, frankly, it's very basic data, but the summary is when markets are at all-time highs, they tend to continue making new all-time highs. And that's just another way of saying markets just go up, right? So in other words, it doesn't make sense just to sell because we're at all-time highs, even if valuations are really high. You don't know. You're going to try to time the markets. Institutions don't try to do that. Well, some do, but yeah, they have a lot more data than retail. So for those reasons, a rather, you would say, a lack of logic behind the idea of selling at a peak when SKEW is really high and VIX is really low, versus solid basic logic saying buy the dip when SKEW is very low and the VIX is really high. That's why the latter tends to actually be a more reliable indicator of buying the dip. So I realized I kind of threw the VIX in there to explain SKEW, but the whole point of talking about the SKEW, I sort of just jumped to okay, how is it useful? Like, how do you put it to work? So right now, we're not in a situation where the SKEW is really low and the VIX is really high. So we can't, based on that theory, perhaps it's not a great idea to just, buy. We haven't, this is not a dip. This is quite the opposite. So,
Luce, can I ask a brief question before? What are the SKEW and VIX based off of? Like, what functional assets are they based on?
all right, I mentioned that.
Not like the tail risk versus the short term and long term. I mean, like,
It's based on the
is
value
it
of the
based-
puts versus the calls on the S&P
like,
index.
within like NASDAQ puts, SPY puts, overall.
No. S&P 500.
S&P.
Yeah. So, where are we now? SKEW's very high, VIX is very low. So what does the SKEW say now? Historically, when the SKEW hits a certain level, it tends to serve as a caution. And it's saying that the markets are insuring their portfolios, they're insuring their long equity positions, their exposure to the overall markets, not necessarily because the markets overall are saying we're going to crash, something's going to happen, but when the markets have melted up the way they have, it makes a tremendous amount of sense to buy some insurance. And I think over the past year, we're up something like 30%, maybe more than 30% probably. So at some point, it's just very sensible to buy some insurance. So right now, the SKEW's at a very high level. That means markets are, they've piled into that tail risk insurance. So when you put it that way, okay, markets are just hedging. They're just buying insurance. If you sign up for insurance today, it doesn't mean you're going to die in 2 months, right? Unless you're United Healthcare CEO, am I right? But all this means is that markets are hedging, right? Now, here's the rub. In the past, when SKEW has hit a certain level, this is going to be a little bit hard to see on screen on YouTube, but I'll do my best. But in the past, when the SKEW has hit a relatively high level, it tends to precede sizable corrections of the market or crashes. The time frame can be anywhere from, say, 3 to 24 months. It tends to be between 6 to 9 months. So, a few examples. The SKEW, it only goes back to about, 2011? Yeah. So, it's about 2011. We got a bunch of smaller examples from 2011, we'll call it beginning of 2018. If we go back to 2018, SKEW hit a high of about 160 in August. And then we had that 20% correction in, through December? So that was a relative high. I think that was the highest SKEW had been since they created the index. So, it's obvious you can call that a relative high or all-time high for the SKEW index. And it indeed preceded a 20% correction in the SPY, which occurred about 4 to 5 months later. If we go forward to 2019, let's see, let me try. Is this going to pop up on? Yeah, we're good on the 5-year, I think. Let me open up the time frame. I'm going to go to 10 years on the day. Yeah. Okay. So back in, where are we? There we go. So back in December of 2019, SKEW hit a level of 150. Wasn't as high as the 2018 level, but still relatively high. And then you had several days when the SKEW index was above 140, going towards 150. This number, by the way, 150, 160, very simplistic way to look at it would be consider it a percent or a decimal. So you could look at it as markets, when the SKEW is at 150, that means markets are paying 1.5 times the amount for out of the money puts versus the same delta out of the money calls. So if you just flipped, right, you just flipped the position, you look at same delta, same percent out of the money, however you want to look at it. It typically it's based on delta. You would say very simplistic way to look at it, because the calculation is a little bit more nuanced than that. But a very easy way to look at it would be SKEW's at 150. They're paying 1.5 times the amount for puts than they would be for calls, or than they are for calls. In 2018, they were paying 1.6 times the amount. So this just means they're paying a lot of money for insurance relative to a bullish play on the SPY. Calls that would be equidistant, right? So in December, we hit a level of 150, so about 1.5 times based on that rough estimate. And then we had COVID. So the markets didn't necessarily predict COVID, right? They didn't predict we were going to have a pandemic. But in these two instances, the 20% correction in COVID, it was a pretty good indicator, right? At least 150. So if we go forward, 2020 SKEW remained fairly elevated. I don't think it touched the 150 level again. And then 2021, we hit a high of 170 in June. And around that time period, we had SKEW hitting levels of 150 to 160. Mind you, there was a lot more retail involvement at this point in time. So you could definitely, it'd be fair to say that retail investors were also starting to learn about unit puts, or maybe they didn't know the term at the time, but they were saying, okay, I'm going to bet on a crash, because I think that was definitely a thing on Reddit. People were just talking, I'm going to bet on a crash in the SPY. It wasn't hedge. It wasn't insurance. They were just making bets. So this probably contributed to the level of SKEW being higher than what it would have been previously. And the evidence of that would be you had SKEW, before a high level on the SKEW was 150, right? Hit 160. Now it's hitting 160, no problem. And then it hit 170. So the level keeps going higher and higher. So institutions plus retail buying those unit puts, whether it's hedging or a bet, it's going to increase the relative value of those far out of the money puts. Now, the reason I point out the retail participation in this is because that number might be going higher and higher because of increased participation, because of increased returns on the S&P. For example, if the S&P was up 50% in 1 year, you bet your ass people are going to be buying a lot of those unit puts. So we're probably going to see SKEW at 180, 190. So the higher the markets go, the more sense it makes to buy those unit puts. You're going to have institutions hedging, buying insurance. You're going to have retail betting that the markets are going to crash. And at this point, I think a decent percent of retail have learned what unit puts are. And that hedging is a good idea. So, 2021, June. Oh, go ahead.
Isn't the SKEW kind of really, essentially any metric based off of the S&P really skewed to the top 10? They'd make up 37% or 35% of the entire S&P, right? Top 10 companies.
Something like that.
So the overall market sentiment is essentially just weighted towards all of those, like most of those companies are tech companies, right? Like Apple, Nvidia, Amazon, Tesla,
Sure.
and they're
Yeah.
essentially all weighted towards growth, right? Would there be value in like essentially calculating? I mean, I'd need to figure out how to do this, or anyone would need to, but like essentially calculating what the tail risk sentiment was with those companies excluded.
That kind of doesn't make any sense because the value of puts on the SPY are not directly related to all the components of the SPY. Like they're not calculated based on the components.
No, they're just calculated on the
So
SPY itself.
yeah, so you take away the tech companies, you throw in other companies there, but the markets are still hedging. You know what I mean?
Right.
Like it doesn't matter what the components are. If the SPY is up a certain percent, the markets are going to hedge more. If it's down a certain percent, they're unwinding those hedges, which is what
Right.
moves the skew level of skew, right?
Right.
Okay, so June 2021, hit a level of 170. It was bouncing around 150, 160 around that time period. And then, what do you know? 2022, we have the bear market. So, another case, it didn't predict one particular correction or a crash, but it did serve as a decent predictor of a prolonged, downturn in the markets. And then I believe over the 2022, we're down just over 20% on the S&P. And let's see, I'm going to have to start looking at the SPY rather than the SKEW here pretty soon. So if I look at May 2023, we hit a level 160. I'll bring up the SPY. So it's May 2023. And then we had a nice correction going through October. So there's another nice little indicator there. SPY was at about 455. And then it dropped down to close to 400. So that's a nice 10% correction. And then you can kind of, maybe it does make a good amount of sense to say the higher the level of skew is, then the greater the correction or the greater the crash, however you like to look at it. Really, the way I look at it is if skew is at a high level, all I'm thinking is that the markets could actually have at least a 10% correction. I'm not trying to place big bets on the table that the markets are going to crash for some unknown reason. But a 10% correction, say 6 to 9 months after the skew is hit 170, I think that's a pretty safe prediction to make. But again, I'm not throwing money at bets that the markets are going to crash and the world is going to die. I'm simply, if I don't already have a hedge in place, I'm increasing my hedge. I'm taking some gains off the table. Overall, I'm remaining invested, and I'm keeping it as a hedge. I'm keeping it as insurance. Maybe I double up on that insurance, but I'm not going full portfolio into betting against the markets. That's not the point of this. But okay, so June we had another nice indicator for a 10% correction over the next 4 to 6 months. And then I think we had, let's see, that was June. December we hit, what was this? 162. And then February we hit I believe that was 170. So December to February, we had those high levels. Particularly in February, we hit 170. And then, looking back at the SPY, we had a nice 10% correction. Or was it 10%? Did we get that 10%? Almost 10%. I think it was just about 10% correction in the SPY in August. It was the whole, unwinding of the leveraged trade on the yen. Short the yen, long markets. And even if you wanted to look at that 160 level back in December 2023, we did have a little bit of a dip earlier in the year from, let's see, about 525 to about 495. So not a 10% correction, but even the 160 level, you might say, maybe we have like a 5 to 7.5% correction on the SPY in the next 4 to 6 months. I wouldn't try to make such a focused bet like that. To me, waiting until it hits 170 and then planning, okay, maybe a 10% correction, 6 months from now, 6 to 9 months from now. That's good enough. That seems to be what the SKEW has been predicting since they created the index. So where does that leave us now? If the SKEW has indeed at a certain level, we'll call it 160, 170, it has predicted 10% corrections in the markets. Let's say anywhere from, I guess you would say anywhere from 3 to 9 months out, but 6 to 9 months tends to be the popular time frame. We hit 171 in September. And then we were high 160s around that time period. So basing it off of September, then that would suggest that, what is that, March? So we're looking at like a March to June time frame is what the SKEW is saying. That's when we're going to have another at least 10% correction. If you looked at it more recently, well, really the past week, we're at high 160s. December 2nd, we hit 170, and we have stayed at 170 and gone higher. Yesterday it was 172. 2 days ago it was 172. Yesterday it hit just about 174. This is the first time I've seen SKEW hang out at that level. That's pretty. Maybe there's something to be said. There's more participation, a hell of a lot more people buying those puts. Therefore, we need to raise the bar as to what SKEW should be. Maybe it's 180 now, right? That would be the theory, right? I don't think there's a lot of research that's been done on this. I've only seen a white paper that goes through the calculation of SKEW. But that basic theory would make some sense to me. Because we are seeing higher and higher levels. And then if you look back at more recent history, the SKEW hitting, say, 170 back in February, it didn't predict a crash. It predicted a 10% correction. Whereas before, we had crashes coming off of 150 to 160 level. So the basic idea that there's more participation, which means more money being put into those unit puts, that insurance, now we should expect a higher level of SKEW if we're going to make these predictions. That makes a bit of sense to me. That said, SKEW being at above 170 for 4 days in a row, that's kind of interesting. I wouldn't be surprised if SKEW actually hit 180. And at that point, I would say it's safe to say, yeah, we're probably going to have greater than a 10% correction in the markets over the next 6 to 9 months, because the markets are definitely starting to think that's going to happen.
Could you link that white paper, Luce?
It might be in one of the forums, but I'll have to look a bit later.
Could add it to the Market Talk description too, for all the watchers.
Yeah,
on
sure.
YouTube.
Yeah, I'll have to find it, or if somebody finds it, let me know. But it might be in market research. Let me see.
So when you start seeing a correction in the market, the SKEW is just gonna start declining very quickly, right? Or do the premiums relatively stay level when there's kind of like that panic?
No, actually, the markets will. So the markets will act on that, and they will begin to unwind those hedges. And there's a very simple explanation for that. It's because you might think like, no, there are people now. There's more fear because the VIX is going up, right? So at the money puts, which is what the VIX is skewed towards, those will be, let's say, traded more or closed out A lot of markets are selling those puts, and now they have to close them out because they're appreciating value rapidly, right? So there's going to be a lot more trading of that, and that is definitely going to send the VIX higher as the markets are going down. However, when the markets are going down, every professional out there in the world is looking at, assuming they're just your goal is to either buy the markets or go long stocks, net long stocks, whatever it is, right? You're just net long. Every professional out there is looking for buying opportunities. If we have hedges in place, that's our insurance. So what do you do when something happens? You cash out your insurance plan, right? So that's what the markets are going to do because they want more money to buy that dip. So that's why you see the SKEW begin to decline fairly rapidly because all of us are cashing out our puts, and that's going to drive the value of those puts down. So even when the VIX is still high,
cash flows from that insurance are essentially reinvested generally within the very assets that they were insured against.
Yeah, oftentimes, yeah. And I mean, sure, if somebody's they're just playing the SPY, then yeah, they're just going to use it to buy the SPY, right? But say, for example, myself, like I'm probably not getting back into the same exact stocks or whatever. Not all stocks are going to move the same, right? Maybe markets crash 30% and NVIDIA drops 50%. Maybe I really want NVIDIA down, at a 50% drop. I'm not buying it now, right? Buying other stocks. So yeah, and then I get to decide, all right, these other stocks that I've been in, how do they look now? How do small caps look on a market crash, right? So like what happens during a market crash? What are the changes in economic policies? How is consumer spending? How are macroeconomics going to affect my small cap stocks? Maybe I don't want to add to them. Maybe not yet. Maybe I want safer returns. Maybe I want to buy Amazon on a 30% dip, So yeah, I'm going to look for value, but I do want the growth, right? So the whole point is I'm going to cash out my hedges, cash out my insurance, and I'm going to look for what I think are the most prudent plays at this point. And typically when you have a crash, assuming that the markets are indeed going to rebound within a favorable period of time, it's not going to take, years. Typically your best bet is to go for growth. However, it doesn't mean just buy any growth stock you like, because not all companies may survive like an economic downturn, right? So that's where you see things like even the Russell tends to not do that well after a market crash. And people would often think, no, small caps, you got to go small caps. Yeah, not according to the Russell.
So weirdly, and this is like this might sound a little counterintuitive, I don't know, but weirdly, the higher the SKEW can get during like, a large melt up, the more secure the market is from like a total crash as opposed to a correction, because what's eventually going to happen is that the SKEW is just showing you that individuals are insured against correction, and all of those cash flows are essentially going to be reinvested in the long term.
You're jumping ahead in logic. So I wouldn't say that, because people could have said that before 2022, and then look how the markets just walked downstairs for an entire year, So and there are a lot of, like, now people are talking, oh, markets just aren't going to crash anymore. I would be very careful about applying any sort of related logic to the idea that markets are always going to be prepared to buy the dips. The whole point is to hedge against tail risk.
Right.
Black swan events. If we have a correction and it's, let's say it's definable, or yeah, you can define it. It's clear what it is. It's explainable, and how to proceed from there, how to recover from that is clear. Then okay, yeah, then the markets are probably going to buy that dip. A true black swan, you don't know what's going to happen. We didn't know how the global economy was going to recover from the global pandemic. We didn't know how we were going to recover from the housing crisis. So I think that's something very important to consider. is we looked at the unwinding of the yen trade back in August. And then at that point in time, it was, okay, is there further to go? Well, if there is, what's going to cause it? It's going to be caused by change in Japanese economic policy, right? Monetary policy. They're going to raise interest rates again, right? And that's going to cause more funds, more institutions to unwind their leveraged trade. So then the question was, okay, well, how much money is still being put on that trade, and will Japan actually do that? And the markets decided, okay, we accept the risk from here on out. It can be calculated. That is not the case when you have an actual black swan risk materialize.
Right.
So,
and that was going to be I'm not saying that my overall sentiment isn't markets are going to crash. I'm just trying to understand this as a mechanism within like the market cycle overall of like, melting up, melting down, versus when everything actually does break down, and you don't see that kind of reinvestment in the long term, and people don't, people might actually panic and sell assets as opposed to, being very diligent and continually just like reinvesting and hedging over and over again.
People will be. I'm sorry. Are you saying you think people will buy, or you think people won't? I feel like you said both.
No, I'm not. I'm saying that like I understand that like the SKEW is essentially tail risk indicator, right? And if there is an actual black swan, market will essentially disregard like this pattern. And I'm more asking questions of like what the instances where you kind of have these breakdowns are, right? Like, and you were just talking about it was like black swan risks like housing crisis or COVID. It has to be very big, unpredictable factors, right?
Yeah. So the whole rub is, so one thing is I wouldn't call it a predictor. I would say it's been very useful in predicting, but there's correlation, not causation, right? And it happens to have been working, which is very important. The same way I would say my strategies have happened. They've been working, but it's not because I am right. It's not because I influence all the stock prices, right? So there's definitely a correlation, not causation. So therefore, it's not, strictly speaking, it's not a predictor. And in terms of, okay, what are the markets going to do when an event does occur? Then yeah, that's where I point to the idea of, all right, do the markets believe that further risk has been calculated and defined? And if the answer is yes, such as the what we saw happen in early August, then okay. And again, it doesn't mean that there was no more risk. It just, to me or to the markets, it would appear that the market said there might be more risk, but we've calculated it and we see what it is. So we're good with this. We accept this risk. Versus, yeah, like the housing crisis, .com bubble, COVID. Yeah. How do you calculate that, right? So at that point in time, you do have to make that decision. But I would say it's better to not try to figure that out, because oftentimes, look at COVID, right? I remember when we were crashing and it was like March 16th, March 17th, and I was like, the global economy is shutting down and we're going to enter like massive recessions. And I was like, I don't know how we fix this, right? And then the Fed said interest rates are going to zero. Every global economy said we're doing the same thing, and we're issuing trillions of dollars in stimulus. And at first I was like, well, how does that fix a global pandemic? I don't get that. That doesn't make any sense. And the markets decided, oh, wait, that's enough. Like, massive liquidity is going to fix this problem. Or whether it fixed the problem or not, markets saw reason to believe that there was a lot of money to be made. So at that point, they decided the reward was worth the risk. Mm-hmm. Now, if professionals have trouble coming to that conclusion, I don't know that retail traders are going to be able to say, like, okay, I should cash out all of my hedges and I should buy this dip today. So I wouldn't say to try to make that decision on your own. I would simply say, if the markets go down 10%, allocate X percent into buying a dip. 20%, another X percent, 30%. I would say to be very systematic about it. Because at the end of the day, whether or not it's the world is going to hell or it's just another 10% correction, if you buy that dip, if you put some money into that dip, from that point on, you're making it a lot easier to beat the markets. Especially if you buy some calls, long-term calls or something like that on the S&P, on some stocks that you like. Typically when the SPY drops 10%, the high growth stocks are going to drop more. What did NVIDIA drop? Something like 25%, maybe 30%, can't remember. So as long as you put some money to work, you're good to go. You don't have to try to figure out what institutions have, algorithms figure out for them. Don't worry yourself about that. Just know that if you place smart bets on good companies, throw in a little growth there, right? And you're systematic about it. You don't go full portfolio into buying like a 10% dip when you don't know how much further the SPY is going to drop. Yeah, just be prudent and you're going to do well. So that's it. So even if the SKEW was like predicting massive market crashes every single time, I wouldn't say everybody go full port into betting on the crash, and then when it happens, 30% down, put out your entire life savings into SPY leap calls. That's not the point. It's when you have an indicator like this that seems that has been this accurate. Yes, take advantage of it, or at least observe it. Try to use it, but don't overdo it, because the fact is you don't need to. There appears to be an edge. Don't be greedy with that edge. Don't try to call the exact percentage drop, or whether it's a massive, even if you've identified, okay, this is a massive event, black swan risk materialized. Okay, do you know whether the markets are going down 40, 50, 60%? No, nobody knows. So just be systematic with buying. Don't worry about trying to figure out what's going on, because frankly, if you did that during COVID, you were probably extremely bearish, and you probably had no idea that the markets were going to just complete V-shaped recovery after being down about 33%.
Yeah, I got killed on that.
Yeah. I still had some shorts open, and I lost half of I made a lot of money on the way down, and then I lost half of those gains because it just, ripping my face off, and I was like, all right, yep, I get it. I got to get out. Like, that's it. I'm not standing in the way of this train. Markets say the crash is over, even though, we weren't in the clear.
Even though nothing makes sense and everything's getting worse.
Yeah, but I learned very valuable lesson there, and it was massive liquidity and almost zero, almost free debt, easy money is what the markets love, and they don't care if everybody's dying. So, or maybe the market said, look, we estimate that maybe 30 million people die from COVID around the world. That's small potatoes compared to 7.5 billion population. And maybe that was it. And that was the end of that calculation, So yeah, be prudent with it. It appears to give an edge. I wouldn't use it as a straight, like, oh, it's going to predict crashes, the apocalypse. Don't go full port. Be systematic about buying dips if they do occur, and keep an eye on that 6 to 9 month time frame, which, by the way, began in September, because that was the first time we hit 170. So at this point, I would say, honestly, maybe this is more. Maybe this is what's more likely is like a bear market from what we saw from 2022. Obviously, you can't. How do you predict, tail risk, black swan risk, right? Nobody predicted COVID-19, right? So I think it's a fool's errand to try to say like, oh, something is going to cause the market crash. We don't know that. But based on what the SKEW is doing, based on current economics, and a lot of global economies, they're still not doing well. Yeah, I could see another prolonged bear market, but again, I'm not placing a bunch of bets on the table. I just have my my hedges in place. I just have some insurance.
Mm-hmm.
And then I'll be systematic about buying those dips. I don't like the idea of just going full cash, or I'm going 50% cash. Like, I mean, look at the SPY. Imagine you went 50% cash back in, like March or April. And then we had that little 7% dip or whatever. You were feeling good about yourself. And then over the next 8 months, you realize, oh, man, that was dumb. So, yeah, I'm not a fan of the go, 50% cash or whatever. You want to go 20%? Okay, no big deal. If you have a dialed strategy where you're using leverage and you don't have to be fully invested, great. That's what I like to do. But it better be dialed in, because the whole point is to still beat the markets in total. So even if you're making 50, 100% on a small amount of capital, well, you have to look at your entire portfolio. What would you be making if you invested the whole thing into the SPY and let it go? Are you still beating? So that's the important part. So you'd have to have it very dialed in if you're using leverage and you have a lot of cash on the sidelines. Otherwise, stay mostly invested. If you're just doing the SPY, okay, maybe you want to go to like 80% invested, and you have a built-in hedge, and you got 20% cash to buy any dips. Nothing wrong with saying I'm going to get, rough calculation, 80% of future returns on the SPY. But if the SPY tanks, I'm, rough calculation, I'm hedged 20%. Not bad. That's not a bad strategy. Not at, these annualized returns. So, yeah, anything less than 80% invested, if you're just doing SPY, anything less than 80% invested, I think you're kind of trying to time a crash or a correction. And I think that's a fool's errand. Buy some insurance. Buy a hedge instead. So, a lot of information about the SKEW. I hope that clears it up. I'll try to find that white paper. I have it somewhere. Let's see. Let me look at your comments real quick. With SPY puts being relatively expensive now, are there other cheaper ways to hedge I'd recommend? If there's liquidity, then and you are highly exposed to specific sectors, then perhaps go with a more appropriate hedge. If you're just loaded up on the NASDAQ, okay, then buy unit puts on the NASDAQ, right? If you're all in tech and the tech ETFs have decent liquidity, go for it. But the problem that tends to occur is if you try to get specific, if you try to say like, I think those are a little expensive, I want to save some money, you're probably going to have liquidity issues, and it's kind of just not worth it. So if the idea is to hedge against a correction or a crash, just go with the SPY. Just go with what has the most liquidity. It's not fun to think you've dialed it in and you're smarter than the markets and you spent less on a hedge, and then a correction starts occurring and there's no liquidity for you. So yeah, just liquidity is king. So stick with the SPY unless you're, like in the triple Q, and unless there's very high liquidity and you're highly exposed to a specific sector. SPY is just the easiest way to go. Flooded the indicators SKEW, SKEW. Yeah, sorry if that was a bit long-winded or I was all over the place. But yeah, there's a lot that goes into it. But yeah, I guess at the end of the day, you just look at SKEW. If it hits 170, Just look 6 to 9 months out. Have a bit of a hedge in place. That's it. I would even go as far to say as if SKEW isn't that high, you might not even need to hedge because, hedge, it's a cost. I try to stay hedged at all times, right? But, yeah, you might even be able to make the case, if SKEW is below 150, yeah, don't bother hedging. No, nobody's predicting anything. And then, yeah, be systematic about buying. Don't try to figure out whether it's going to be a massive drop or not. Just be systematic about buying the dip. And here's the way I see it. If it dips 10%, you put some money into a 10% dip, and then markets rebound. If that's it, just 10%, markets are probably going to rebound pretty quickly because it's not that big of a deal. You're going to feel good about yourself, especially if you bought some growth stocks. And you're going to say, damn, I did that so well. I'm a professional. If the markets keep dropping, you get even better entry points. Just think in terms of numbers. Take the numbers at face value. Be systematic. Forget the opinions. Just stats, probabilities, dollar cost average. And then think about the idea that if you buy on a dip, you are basically, in a way, you're destined to beat the markets. And that can feel pretty good. The number one way hedge fund managers beat the markets is by getting more capital to buy the dips. So take your half of your next paycheck, if the markets drop 30%, and put half into the markets. You are now doing what hedge fund managers do. That's got to be 50% of the reason why hedge fund managers will beat the S&P, just because they get more capital to buy the dips. OP man finally found Discord. Congratulations. All right. For YouTube people, this went a little bit longer than I expected. Booper just said GME. Good job. Andy said no. Good job. Mark, it's hard as hell to beat the SPY. I'm going to say this year, I think it was easy. Last year, I think it was hard. I think last year was pretty damn hard. 2021, easy.
2020?
2020, yeah. All you had to do... let me think. 2020... Because I beat because I had an interesting strategy I was using, and it was funny because I was about to stop using it, and then it knocked it out of the park during the crash. And it was like half the reason I beat the SPY in 2020. I know plenty of people that discovered stocks during COVID because of YouTube or whatever, and they bought the dip just because. Not because they were like, oh, this is a dip and I know the probabilities. They just bought. And a lot of them bought calls and the SPY just melted up. And then they said, I'm a hedge fund manager. I know how to do this. So I think if you entered at the right time, then it was easy. If not, it may have been difficult. You kind of had to follow the herd, to be honest. So 2020, I guess it depends, like how you got in. 2021, I think it was easy. I think that's what Warren Buffett thinks about when he says if he started investing today, he would be making 50% annualized, no problem. He's talking about how easy it is just to find trends. And I think part of that comment is based on the idea that companies that don't even have strong fundamentals, they just have certain keywords that are trending Nobody looks at financial analysis or fundamentals or valuations. They just say, shut up and take my money. And then a lot of institutions will trade that sentiment.
They just say AI and it's...
Yeah, AI was a
there.
good example. Yeah. And all you had to do was, take AI, for example. What did you have? You had, we had that, what is that company? C3 AI. They just changed their name. And if you look back, let's see, beginning of 2023, if you bought them because they had AI in the name, the stock went from about $10 a share to a high of above 40. And then it proceeded to have a terrible next year, close to a year and a half. You had so many exit points on the way to 40 on a stock that did so well just because they changed the name to AI. That's why Warren Buffett says he could easily make 50% returns annually. So if you don't think that this year's market was one of the easiest markets to trade and to invest in, you need to go back to the drawing board. If you can look at certain trades that you make and say, I put a lot of money into this one stock, or I threw a lot of money at calls over and over again, or whatever, or I day traded and I messed it up. If you can look at specific points in time and say, okay, that's why I didn't beat the markets, or that's why I was down, whatever, good. That's great step in the right direction. If it's your entire strategy, if just nothing worked, then that's where, okay, hard reset, go garden for a few months. But if you think this market, if it was hard to beat the markets this year, I think this was the easiest market to beat the professionals that I've seen probably since the dot-com bubble. I mean, I wasn't trading them, but I know my history and I know the price movements. But yeah, I remember dot-com bubble, and it was basically you had traders, you had all of Wall Street saying just buy, buy, buy. And the valuations became ridiculous, and it didn't matter. You just followed. You just followed the herd and pick whatever popular stock, and that was it. And then you had everyone claiming victory. I told you I was right on this stock. Screw you and your valuation, your fundamental analysis. And frankly, as a professional, I'm like, yeah, okay, good game, like good year. I still don't know if the people talking mess that they actually beat because they don't post any performance, right? Some people have screenshots of Robinhood, and that's cute. But at some point, I'm like, okay, enjoy this. I hope it lasts. But at some point, you're going to have to get smart. And every now and then, the markets will give you, a year like this. And that's great. It's fantastic. Easy money. Better to be lucky than be right. Nobody, any professional, will take luck over being accurate, being right. Myself included. I don't care. Give me luck. Give me all the luck. But yeah, this was an easy market. Yeah, just look at the mega cap stocks. You could have gone mega cap. You could have gone small caps. You could have just gone Nvidia. You could have gone Apple at the beginning of this year. Everybody it was doom and gloom for Apple. And then they popped up on the relative valuation list, and they knocked it out of the park. Let's see. Went up about, what was it? About 170, maybe about the 170 level. And they're up about $75 from that. That's insane return for Apple. Hey, beat the markets. Nice and easy. By buying Apple on a dip. Yeah, come on. It was easy. If you made more than 100% and you weren't exactly gambling, And that's impressive. I made over 100% on certain plays, certain stocks, but not for, overall, not total. All right, so I think we've been going long enough. Discord, we'll keep the party going. YouTube land, I'm going to stop the talk here, and we'll pick it up again Monday morning at 9:15 Eastern. Real quick before we leave, I'm going to read the tape. S&P futures are up 0.21%. NASDAQ's up 0.66%. Dow is down 0.1% now. Russell's up 0.47%. VIX futures are about flat, down 0.84%. Treasuries are now about flat. The 20 years are down. Gold is up 0.4%. Crude is down 1.4%. Nat gas is up 0.23%. Bitcoin is up 0.4%. The FTSE is down 0.4%. Asian markets are closed. The dollar is up 0.26%. Looking like a fairly uneventful day. So yeah, that's all I got for YouTube people. Have a good weekend. I'll see you guys Monday.